there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video will cover several questions from Chapter 5, which covers earnings and profits and dividend distributions of a corporation. So for this first question, it asks, select either increase, decrease, or not affected, whichever is applicable. In determining Blue Corporation's current earnings and profits, E&P, for 2024, how should taxable income be adjusted as a result of the following transactions? So, as it relates to earnings and profits, please keep in mind that it's similar in many respects to the accounting concept of retained earnings. Both retained earnings and earnings and profits, often referred to as E&P, they measure the firm's accumulated capital. Earnings and profits in particular, it includes both accumulated E&P of the corporation since its date of incorporation, as well as the current year's E&P. However, there's a difference between earnings and profits and retained earnings in the way in which they are calculated. So the computation of retained earnings is based on financial accounting rules, whereas earnings and profits is determined using rules that are specified in the tax law. So Congress hasn't necessarily provided a specific calculation of earnings and profits in the internal code. However, there's what's called Section 312, and in that section, they have provided adjustments that need to be made to the corporation's taxable income to arrive at E&P. So simply stated, earnings and profits, it's the economic measure of a corporation that determines their dividend paying capacity. All right, so as it relates to dividends, there are two ways in which essentially corporations raise money. The first is debt, whereby they borrow money from individuals and corporations. They issue bonds and they promise that they are going to pay back the principal amount in addition to interest. And the second way in which they can raise funds is through equity. And that is where individuals, both corporations and individuals, they invest into the company for shares of ownership. And in such case, when someone invests into the corporation through equity, they often receive dividends. So earnings and profits in particular deals with equity of a corporation. So the key thing, again, earnings and profits, is the dividend paying capacity. So for tax purposes and financial purposes, there are some differences, some nuances. There's certain income that is reported for accounting purposes, but not recorded for tax purposes, and vice versa, the same with deduction. So here we have an example. In A states, a capital loss carryover from 2023 fully used in 2024. So in such case, this would increase the earnings and profits. Capital loss carryovers in succeeding taxable year is an increase to taxable income because the loss reduced the earnings and profits in the prior year, 2023. B, we have non-deductible meal expenses in 2024. So in 2023 and 2024, 100% of business meals are deductible in the calculation of taxable income. However, before 2023 and after 2024, the general rule is that only 50% of business meals are deductible in order to calculate taxable income. But for the purposes of calculating E&P before 2023 and after 2024, the non-deductible 50% portion of business meals, it's a negative adjustment to taxable income. So again, for tax purposes, the E&P or the meal expenses rather, it's only subjected to 50%. But if we think about it from the capacity of the corporation being able to pay dividends, which is generally in the form of cash, they paid for the expense. So therefore, that ultimately decreases the amount of cash that the corporation has available. So this would decrease the E&P. Next, we have interest on municipal bonds received in 2024. So the same logic. So to determine current E&P, it's necessary to add all previously excluded items back to taxable income. So for tax purposes, interest on municipal bonds, is not considered taxable. However, if we think of it logically, the interest is money that the company is receiving. So therefore, they have more money on hand, which increases their dividend paying capacity. Next, we have non-deductible lobbying expenses in 2024. For tax purposes, lobbying expenses are not considered deductible. However, from the logical perspective of the dividend paying capacity, money was paid. Therefore, this decreases the corporation's dividend paying capacity. E, we have loss on a sale between related parties in 2024. In such case, a related party loss has a negative impact. So therefore, this would be decreased. And then lastly, we have federal income tax refund received in 2024. So much like C, the interest on municipal bonds received in 2024, federal income tax refunds are not treated as income. However, again, we're thinking of it from a logical perspective. The cash that we have, the monies available, the federal income tax refund presents more cash to the business. So therefore, it increases the dividend paying capacity. So ultimately, the federal income tax refund would increase the earnings and profits for a corporation. Next for this question, it asks to classify the effect of a distribution in a year when the distributing corporation has the following conditions. So there's some different scenarios that can take place when we're dealing with E&P. And as mentioned, we have what's called current E&P and we have what's called accumulated E&P. So our accumulated E&P is the total of all previous years' current E&P reduced by any distributions made from E&P in the previous years. It is extremely important to distinguish between current E&P and accumulated E&P. Reason being, because the taxability of a corporate distribution, it ultimately depends on how these two accounts are allocated to each distribution that's made during the year. So there's a complex set of rules that governs the allocation process. So it ultimately depends. Does both current and E&P, accumulated E&P rather, do they both have a positive balance at the date of distribution? Do they both have a deficit? Or is it that current E&P and accumulated E&P, one has a positive and the other has a deficit? Those factors ultimately have an impact again on how much of the distribution would be treated as a dividend, how much of the distribution would be treated as a return on capital versus how much would be treated as a taxable gain, if any. So with A, in the event that a distributing corporation has a deficit in accumulated E&P and a positive amount in current E&P, how would that be treated? So in the event that there's a deficit in accumulated E&P and a positive amount in current E&P, current and accumulated E&P is not netted. Instead, the distributions are dividends to the extent of current E&P, and in the event that the distribution exceeds the current E&P, then the excess first reduces the stock basis to zero, which is in the form of return of capital, and then anything in excess of the stock basis is going to be treated as a capital gain. So in this case, a distribution during the year is a taxable dividend to the extent of current E&P. Current and accumulated E&P are not netted. So that's if there's a deficit in accumulated E&P and a positive amount in current E&P. For scenario B, it says if there's a positive amount in accumulated E&P and a deficit in the current E&P. So in such case, the current and the accumulated E&P, they are netted in such case. So whenever there's a deficit in current and a positive in accumulated E&P, again, current and accumulated, they're netted, and any loss in the current E&P is deemed to have accrued ratably throughout the year unless the corporation can show otherwise. So when we net our current and our accumulated E&P, if the net amount is positive, then the distribution is a dividend to the extent of the balance. And, again, with distributions, it's always in tier of three. The first is that it's going to be treated as a dividend. Second, return of capital, which reduces the stock basis. And third, which is the taxable gain if there's an excess for the stock basis in the amount that when we net current and accumulated E&P and it is negative, there's no amount that is going to be treated as a dividend. Instead, the distribution is treated as a return of capital, first reducing the stock basis to zero and then generating a taxable gain. So therefore, if the corporation has a positive amount in accumulated E&P and a deficit in current E&P, a distribution is either a taxable dividend or a return on capital. Again, it ultimately depends on when we net the current E&P deficit and the positive accumulated E&P, is the net amount positive? If the net amount is positive, it's treated as a taxable dividend to the extent of the net. But if the net amount is negative, the distribution is treated as a return of capital. Again, depending on a result of the balance when current and accumulated E&P is netted. C, if there's a deficit in both current and accumulated E&P, in such case, the distribution is treated as a return of capital, first reducing the basis of the stock to zero, then generating taxable gain. So therefore, it's treated as a return of capital to the extent of the shareholder's basis in his or her stock, and any excess is treated as a capital gain. Next, we have if there's a positive amount in both current and accumulated E&P. In such case, current E&P is applied to the first distribution on a pro rata basis. Then accumulated E&P is applied, if necessary, in chronological order, beginning with the earliest distribution. So if there's a positive balance in both current and accumulated E&P, it is treated as a taxable dividend. So as mentioned, again, it is very important to distinguish between whether or not there is a current E&P, accumulated E&P, and whether the balances at the time of distribution, if they are positive, a deficit, or if it varies based on current and accumulated. Next, we have this question that asks, when determining how the distribution is treated for tax purposes by the shareholders, indicate whether the following factors should be considered by selecting either yes or no. Orange Corporation distributes $200,000 in cash to each of its three shareholders, Sandy, Byron, and Fuchsia Corporation. So for A, it states, what is the current balance of E&P Orange Corporation? So the answer is definitely yes. As we just discussed in the previous problem, to the extent that a distribution is made from corporate earnings and profits, the shareholder is deemed to receive a dividend taxed as ordinary income or as preferentially taxed dividend income if it's qualified dividends if certain rules are met. And generally, corporate distributions are presumed to be paid out of the earnings and profits. They're treated as dividends unless the parties to the transactions can show otherwise. Distributions, they might not be treated as dividends if there's insufficient earnings and profits. And in such case, then again, as mentioned earlier, distributions are treated based on a three-tier structure. First is treated as dividends, then it would be treated as a return of capital, which would reduce the stock basis to zero. And if there is still an excess distribution, that excess amount would be treated as a taxable gain. So yes, this would essentially be a factor. B states, how long have Sandy and Byron been shareholders? So no, the length of time that an individual has been a shareholder, it does not affect how the distribution is going to be treated for tax purposes. So this has no bearing at all. C, Has E&P been accurately determined for tax purposes? Yes, this is definitely of importance because as E&P fixes the upper limit on the amount of dividend income that the shareholders have to recognize as a result of the distribution by the corporation, the accuracy is very important. D, how much E&P is allocated to each shareholder's distribution? Yes, this is also of importance. Why? Because again, once these distributions are made, it is essential to distinguish between current E&P and accumulated E&P because the balances in these accounts, whether they are positive or at a deficit, it ultimately determines the taxability of the corporate distributions. E, how will the distribution affect Orange Corporation's E&P? Yes, this has an impact because as we know, earnings and profits, it serves as a measure of the corporation's earnings that are available to distribute as taxable dividends to the shareholders. So again, at the very basic level, earnings and profits determines the dividend paying capacity of a corporation. F, what is the tax basis to the shareholders of the Orange Corporation stock? Yes, this would also essentially have an impact because in the event that a distribution was made and a portion of it needs to be treated as a return of capital, the shareholder would be required to adjust their stock basis. Hence, this would make a difference. We move on to the next question where it asks, complete each of the parts below, first isolating the gain loss for each machine and ending part D with your recommendation. Raven Corporation owns 3 machines that it uses in its business. It no longer needs 2 of these machines and is considering distributing them to its 2 shareholders as a property dividend. All 3 machines have a fair market value of $20,000 each. Their basis is as follows. Machine A has a basis of $27,000. Machine B has a basis of $20,000. Machine C, a basis of $12,000. The corporation has asked you for advice. So, property distributions, they have a similar impact to distributions of cash, except when there's any effects that's attributable to any differences between the basis of the property versus the fair market value of the distributed property. So in most situations, distributed property, it's appreciated. So what that simply means, let's say the corporation has a building, they paid $100,000 for the building, and now the fair market value of the building is $150,000. That is an example of appreciated property. Now, let's say the corporation paid $100,000 for the property and the current market value is $80,000. That is an example of depreciated property. So in this case, again, all 3 machines have a fair market value of $20,000. So distributing machine A, the cost basis of the machine is $27,000. And all 3 machines have a basis of $20,000. So if you purchase something for $27,000 and you are now selling it for $20,000, you have $7,000 of a loss. So in such case, there would be a non-deductible loss of $7,000. So I'll explain the non-deductible reason. So distributing machine A would produce a non-deductible loss of $7,000. Again, it's the $20,000 minus the $27,000. So in such case, with corporations, when they distribute lost property, they are not allowed to claim the loss. So in such cases, it is better advised that the corporation first sell the lost property, and then from there, they essentially issue or distribute the proceeds to the shareholders. So gains for appreciated properties are recognized. However, the distributing corporations do not recognize losses on the distribution of property. B, If Raven distributes machine B, the result will be. So in this case, we sold it for 20,000. The fair market value was 20,000. In such case, there's no gain, there's no loss. We sold it for exactly how much we paid for it. So 0. C, if Raven distributes machine C, the result would be we paid $12,000 for the machine and we sold it for 20,000. So in such case, there would be a taxable gain of 20,000 minus 12, which gives us 8,000. Therefore, to preserve the loss on machine A, because again, we have a loss for A, we want to preserve the loss on machine A. Raven, as mentioned earlier, they should consider selling machine A. Sell machine A because from there they can essentially use the proceeds and distribute it to the shareholders versus distributing it, the property, the lost property to the shareholders, and they get no benefit from it. Raven should consider distributing machine B because there's no recognized gain or loss on the transaction. So it doesn't matter if you keep it, if you distribute it, no gain or loss is going to be recognized. In regard to machine C, in such case, they might want to avoid recognizing the gain. So as mentioned, when there's property dividends, the effect on a corporation is that for appreciated property, a taxable gain is going to be recognized, but for losses, as we see in scenario A, losses are not recognized. So in order to avoid recognizing a gain on machine C, Raven should consider neither selling nor distributing the machine C, so that way they don't have to pay any taxes on the gain. We move on to the next question, and here it asks, all or part of the salaries of which employees, if any, may be deemed unreasonable compensation. So it states Holly and Terry are the only shareholders of Pink Corporation. Judy and John share equally in the management of the company's operations. Holly and Terry are both full-time college students at a university 200 miles away. Pink has substantial E&P and has never distributed a dividend. So there's some key things to keep in mind. A salary payment to a shareholder employee that's deemed to be unreasonable compensation, it's often treated as a constructive dividend, and as a result, it's not deductible by the corporation. So in determining the reasonableness of salary, there's a number of factors that are considered. What is the employee's qualifications? You compare it to salaries, the salaries with dividend distributions. What's the prevailing rates of compensation for comparable positions in comparable businesses? What's the nature, the scope of the employee's work? What's the size and the complexity of the business? They also compare the salaries paid with both the gross and net income. What's the taxpayer salary policy towards all employees? And whether a reasonable shareholder would have agreed to that type of compensation paid. These are some things that are important to determine whether or not it should be deemed reasonable compensation, or if it's unreasonable compensation, it's treated as a constructive dividend. So in this case, we see Holly and Terry are vulnerable to the constructive dividend treatment. Since neither shareholders have appeared to earn the salaries paid, we have Judy, we have Holly, we have Terry, we have John. So Holly is Judy's daughter and Terry is Judy's son, and they both are earning a salary of $100,000. We also see the $470,000 salary payment to Judy. All right, so John is an unrelated party. Someone might be considering, all right, why is she receiving $150,000 more? Right? Both John and Judy, they share equally in the management of company. As we consider Holly and Terry, they're both full-time college students at a university 200 miles away, and they're making $100,000, 6 figures each year. So one of the key things, a corporation, they can provide indirect compensation to shareholder employees by paying them expenses that benefit them personally. But these are not or deductible to the corporation. But in this case, let's say if they were paying premiums for the individuals and things of that nature. But in this case, we see obviously Holly and Terry, they're far away, not working in the business. So these are some things that need to be considered. So in such case, Terry, Holly, Judy, it's more than likely that the IRS might deem that it's treated as a constructive dividend. It's unreasonable compensation. So, as mentioned, John and Judy, they both share equally in management, but Judy's making $150,000 more. So, although Judy's not a shareholder, her relationship to Holly and Terry, Holly is her daughter and Judy is her son, that's enough of a link to raise the unreasonable compensation issue. In addition, it lets us know that Pink Corporation has never distributed a dividend despite having substantial E&P. So given the corporation's dividend history and the disparity of the salaries, the IRS might be able to successfully argue that all of the salary that was paid to Terry, to Holly, as well as a portion of Judy's salary, the amount that is in excess of how much was paid to John, the difference of $150,000, might be deemed unreasonable. So the correct answer is Terry, Holly, and Judy. Next, it asks us to complete the letter to Raptor Corporation President Sarah Isaacs. Your client, Raptor Corporation, declares a dividend permitting its common shareholders to elect to receive 9 shares of cumulative preferred stock or 3 additional shares of Raptor common stock for every 10 shares of common stock held. Raptor has only common stock outstanding, fair market value of $45 per share. One shareholder elects to receive preferred stock while the remaining shareholders choose the common stock. Raptor asks you whether the shareholders have any taxable income on the receipt of the stock. So it's asking us to complete the letter to Raptor Corporation's president, Sarah Isaacs. So this is SWFT LLP at 5191 Nathorpe Boulevard, Mason, Ohio, November 16, 2024. Sarah Isaacs is the president for Raptor Corporation. 1812 South Camino Seco, Tusco, Arizona, 85710. So we start off, dear Ms. Isaacs, this letter is in response to your question about the stock dividend distributed to your shareholders. Our conclusion is based on the fact outlined in your November 13th letter, and any changes in these facts may cause our conclusion to be inaccurate. So as it relates to stock dividends, historically, stock dividends were considered excluded from income, simply stated because the ownership interest of the shareholder was ultimately exchanged. The basis in the stocks remain the same. What does change, however, is that you own more stock. So in such case, it's important to be able to determine what the impact is, and this is governed by Section 305. So as a general rule, stock dividends are excluded from income if they are pro rata distribution of stock or stock rights paid on common stock. Therefore, the distribution of preferred stock to some common shareholders and of common stock to other common shareholders, this would be considered a taxable event. In such case, your shareholders have taxable income equal to the fair market value of the stock. So the reason why this is important is because there are some exceptions to the general rule. So in the event there's distribution payable in either stock or property at the election of the shareholder, if there's distributions of property to some shareholders with a corresponding increase in the proportionate interest of the other shareholders in either assets or the earnings and profits of the distributing corporation, if there's distribution of preferred stock to some common shareholders and of common stock to other common shareholders, as we see in this example, hence why it raises a taxable event. 4, if there's distributions of either common or preferred stock to preferred shareholders. However, if there's changes in the conversion ratio of convertible preferred stock to account for a stock dividend or stock split, in such instances or certain circumstances, rather, it would still not be taxable. And lastly, if there's distributions of convertible preferred stock, unless it can be shown that the distribution will not result in a disproportionate distribution. So it met one of the exceptions because the distribution of the preferred stock was to some common shareholders and common stock to other common shareholders, a taxable event was triggered. So for B, it's asking us to complete the internal memo regarding Raptor Corporation, which outlines the issue, analysis, and conclusion. So here we see, based on the facts summarized in a letter dated November 13th from the president of Raptor Corporation, the following occurred. Raptor Corporation declared a dividend permitting its shareholders to elect to receive either 9 shares of cumulative preferred stock or 3 additional shares of Raptor common stock for every 10 shares of common stock held at the time of the dividend declaration. 1 shareholder elected to receive preferred stock, while all other shareholders chose the common stock. Issue: is the distribution of a stock dividend taxable if some of the shareholders elect to receive preferred stock while others elect to receive common stock? So the analysis is as such. Code 305 governs the taxability of stock dividends. It provides that stock dividends are not taxable if they represent pro rata distributions on common stock. However, as we saw, there were 5 exceptions, one of which applies in the present situation. When there's a distribution of preferred stock to some common shareholders and of common stock to other common shareholders, this is considered a taxable event. So therefore, the conclusion is the shareholders have a taxable income equal to the fair market value of the stock dividend. This brings us to the next question. So in this question, it states, at the beginning of the year, Myrna Corporation, the calendar year taxpayer, has earnings and profits of $32,000. The corporation generates no additional E&P during the year, and on December 31st, the corporation distributes $50,000 to its sole shareholder, Abby, whose stock basis is $10,000. How is the distribution treated for tax purposes? So considering this fact pattern, we ultimately need to determine how much is going to be taxed as a dividend versus being taxed as return of capital, etc. So as we go through the fact pattern, we ultimately again need to determine, all right, how much is the distribution, how much of the distribution rather is going to be treated as dividend income, return of capital, or stock basis. So here we start off with this fact pattern as follows. All right, so for Abby, we're actually going to use this. So here for Abby, all right, so same fact pattern, we're dealing with Myrna, but in this case, the earnings and profits, $32,000. The corporation generates no additional E&P on December 31st. They distribute $50,000 to the sole shareholder, and Abby has a stock basis of $10,000. So we have an Excel spreadsheet, and we'll work along it side by side. All right, so in this example, The accumulated E&P at the beginning of the year is as follows. So, based on this problem, it lets us know that we have accumulated E&P of 32,000 at the beginning of the year. And it says the corporation generates no additional E&P during the year. So 0. The total distribution per the problem is 50,000. And then Abby's stock basis, in this case, is 10,000. So based on this, we need to determine, okay, well, how much is going to be earnings and profits? So in such case, we know that earnings and profits is ultimately always dependent upon the amount that is in the accumulated and the current earnings and profits. So in this fact pattern, we have no current E&P, but we have a positive balance in the accumulated E&P. So as we know, distributions, to the extent that a distribution is made from the corporation's earnings and profits, E&P, then the shareholders deemed to receive a dividend, again, it's either treated as ordinary income or preferentially tax dividends, qualified dividends. So the corporate distributions are presumed to be paid out of earnings and profits and are treated as dividends unless the parties to the transactions can show otherwise. So in this case, Abby, she's going to recognize dividend income of 32,000 to the amount of the earnings and profits distributed. So 32,000 is going to be treated as dividend income, but we know that $50,000 was distributed. So in such case, the remaining 18,000, and how do we determine 18,000? So there was a $50,000 distribution. 32,000 was treated as E&P, so therefore there's a remaining distribution of 18,000. So this is the first tier, dividend income, and then from there the remaining portion is treated as a return of capital to the extent of the stock basis. In this case, Amy's stock basis is 10,000. So now the remaining distribution is the total distribution minus the amount treated as dividend income minus the amount treated as a return of capital, which in this case is 10,000. So the 18,000 minus the return of capital, therefore the remaining amount, I'll actually do it this way. All right, so the capital gain is going to be as follows. The 50,000 at the first tier, it is treated as dividend income. And at the second tier, it is treated as a return of capital. And the maximum return of capital is based on the stock basis. And in this case, Abby's stock basis was 10,000. So therefore, the excess of $8,000 is treated as a capital gain. So dividend income to the extent of E&P. The distribution was 50,000, so we still have an excess of $18,000 worth of a distribution. The stock basis was 10,000, so therefore the return of capital is 10,000. The capital gain would represent the excess of the distribution treated as a dividend income, less the maximum return of capital, which reduces the basis to 0. So the extra $8,000 will be treated as a capital gain. The stock basis after the distribution in this case would be 0. Why? Because the return of capital reduces Abby's stock basis to 0. Now we move on to this next question. It asks, answer the following questions to determine whether Rover is correct in believing that a dividend is the better choice. So it states Rover Corporation would like to transfer excess cash to its sole shareholder, Alicia, who is also an employee. Alicia is in the 24% tax bracket and Rover is subject to a 21% tax rate. Because Alicia's contribution to the business is substantial, Rover believes that a $25,000 bonus in the current year is reasonable compensation and should be deductible to the corporation. However, Rover is considering paying Alicia a $25,000 dividend because the tax rate on dividends is lower than the tax rate on compensation. So here it asks for A, regarding the taxes, which would benefit Alicia the most? So in this case, we have what's called a closely held corporation. And with closely held corporations, it's very important. Again, it's fairly similar to what we were discussing with the unreasonable compensation and amounts being treated as unreasonable compensation. Therefore, it's treated as constructive dividends. So in this case, and we're dealing with a closely held corporation, they have a considerable discretion regarding their dividend policies. So in the past, double taxation, as we know, which is one of the downsides of the corporate structure that ultimately has an impact on the corporation paying the 21% flat tax rate. And then from there, once the dividends are issued, it is taxed again to the shareholder. And that's one of the challenges of the corporate tax structure. So therefore, the corporation wants to ensure that when they are making the decision, who is it going to benefit? How does it benefit the corporation versus how does it benefit the shareholder? So in such case, the question becomes, should the corporation or should the shareholder benefit? So in general, the best strategy considers the tax consequences to both parties. And if it's properly structured, then the deductible payments by the corporation to the shareholder still appear to be preferable to dividends in most situations, unless, of course, the corporation faces a low tax rate. So this would obviously benefit shareholders that are subjected to alternative minimum tax. So we look in this situation, scenario A, which would benefit Alicia the most? So if it were a dividend payment, we would factor it in as such. So the dividend payment will be $25,000. And then from there, we factor in the payment, multiply by the tax rate, the dividend rate, which is 15. So in such case, our calculation would be as follows: 25,000 minus the payment multiplied by the tax rate of 15%. And this gives us our after-tax amount. So in such case, the after-tax amount is $21,250. In the event that Alicia were paid a bonus, the impact would be as follows. There's a bonus of $25,000. And then we factor in the payment in comparison to her tax rate, which is 24%. So the after-tax amount will be as follows: 25,000 minus the 25,000 times the tax rate of 24%. So the after-tax amount would be $19,000. So therefore, in such case, to Alicia, it would make the most sense for her to receive a dividend because the after-tax amount would be $21,250 versus $19,000 if she received a bonus. So in such case, $21,250 dividend, because she would have $21,250 from the dividend and $19,000 from the bonus. Regarding taxes, now it asks, how would the corporation, Rover Corporation, benefit most? So similar, we factor in the 25,000 times the corporate tax rate, which is a flat 21%. The tax savings would be as follows: 25,000 multiplied by 21%, $5,250. So for the corporation, it would benefit them if they paid the bonus, because bonuses are deductible, dividends are not. They would be able to save $5,250 in taxes. So now, in such case, it benefits Alicia more to claim the dividend, but it benefits the corporation more to claim the payment as a bonus. So we need to factor in for both parties. So considering the two parties together, which alternative would provide the most overall tax savings? So in such case, we need to factor in, okay, for Alicia, how much does she save? 21,250 minus the after-tax bonus of 19,000, the net savings in Alicia's case is 2,250. So now from there, we factor in Rover's benefit. Rover's benefit would be the tax savings of 5,250, which is the $25,000 bonus payment, multiplied by the tax rate of 21,000. So Rover would have tax savings of 5,250 minus Alicia's benefit in this case, which is 2,250. So therefore, the net savings from treating the amount as a dividend would be Rover's tax savings benefit of 5,250 minus Alicia's benefit of 2,250. So therefore, the net savings would be $3,000. So considering the two parties, the alternative that will provide the most overall tax savings is the $25,000 bonus, because when the overall effect to both the corporation and the shareholder are considered, the net tax saving is $3,000. So again, this is great opportunities for tax planning to understand the nuance between, what happens with distribution of a dividend versus it being paid as compensation or a bonus and things of that nature. And as we can see here, this is on a small scale, but imagine when a corporation is dealing with hundreds of thousands or millions of dollars. So we move on to our next question. And in this question, it asks, Fargo Corporation distributes property of $260,000 with a fair market value of $310,000 to a shareholder. Fargo Corporation has sufficient E&P for its distributions. So what are the tax consequences of this distribution to Fargo? So in such case, we see the basis was 260,000. The fair market value of the property was 310. So this is an example of a property dividend where there is appreciated property. So 310,000 minus the basis of 60,000, there is a gain of 50,000. So as we know, corporations, when they distribute property as a dividend, they recognize the gain. However, they do not recognize losses. So in such case, Fargo Corporation recognizes a gain of 50,000. In such case, this has a decreasing effect on the earnings and profits. The net decrease to Fargo's earnings and profits would be $260,000. And then the shareholder, on the other hand, would have to recognize dividend income of $310,000. So although most corporate distributions are cash, there are situations like this where a corporation may distribute a property dividend for various reasons. So in such case, the shareholders could want particular property that's held by the corporation. And similarly, maybe the corporation has low cash reserves, right? But the key thing is that when the corporation distributes property, they need to think about the effect to the shareholder as well as the effect to the corporation. All right, here we see this example. It asks, what are the tax consequences to Euclid from the following independent events? So in your computations, do not round. Intermediate division, if required, round the per share answer to 2 decimal places. Round all other answers to the nearest dollar. So here it states Euclid bought 500 shares of common stock 5 years ago for $50,000. This year, Euclid received 20 shares of common stock as a non-taxable stock dividend. As a result of the stock dividend, Euclid's per share basis is. So based on this information, the total cost before the stock dividend was 50,000, and the number of old shares was 500. So therefore, the per share basis for the old shares was 50,000 divided by 500. It was $100 per share. So this is the old stock. All right, so this is the old per share basis. But now in this example, the cost is 50,000 and the number of shares is 500 plus the new shares, so 520 shares. So in this new scenario, the total cost is as follows. 50,000 divided by 520. So the new per share basis would be $96.15. So again, how do we determine it? It's the total cost divided by the old number of shares, 50,000 divided by the 500 in shares. The total cost, it's still $50,000, the basis. However, in total, we now have an additional 20 shares, so for a total of 520. So our per share basis is 96.15. But again, if we multiply the 96.15 by 520, we get the same basis of $50,000, right? So that's for part A. For part B, it now asks, assume instead that Euclid received a non-taxable preferred stock dividend of 20 shares. The preferred stock has a fair market value of 5,000, and the common stock on which the preferred is distributed has a fair market value of 75,000. After the receipt of the stock dividend, what is the basis of the preferred stock? And what is the basis of the common stock? So in order for us to determine, it'll be calculated as follows. So the fair market value of the preferred shares is 5,000 based on a fact pattern. And the fair market value of the common shares is 75,000. All right, so that gives us a total basis of 5,000 plus 75,000. That gives us a basis of 80,000. And now we need to determine, well, what is the basis of the preferred shares? How will we determine it? So it will be the fair market value of the preferred shares divided by the total fair market value. So the total fair market value of shares. This total fair market value should suffice. So the total fair market value. All right, so it'll be as follows. The fair market value of the preferred shares, in this case, is 5,000. And the total fair market value is 80,000. All right, so 5,000 divided by the 80,000. All right, so divided by the total cost. And the total cost in this case, as we know, is 50,000. So our calculation would be as follows. We'll put it in brackets, 5,000, which represents the fair market value of the preferred shares, divided by 80,000, which represents the fair market value of all shares, multiplied by the total cost of 50,000. In such case, the basis of the preferred stock would be $3,125. Again, how do we calculate that? It's the fair market value of the preferred shares, which is 5,000, as stated in the fact pattern, divided by the total basis of both the preferred shares plus the common shares, which gave us a total 80,000. So we're basically allocating it on a pro rata basis. So once we get that allocation, we multiply it by the cost basis, which we calculated before, or the amount that was given before of $50,000. So therefore, $3,125 would be allocated to the preferred stock. And we essentially do the same thing for the common shares. So for our common shares, we know that the fair value of the common shares is 75,000. The total shares are 80,000. And then we know that the cost is $50,000. And we do essentially the same calculation that we did up above. So it would be 75,000 divided by 80,000 multiplied by the cost basis of 50,000. So therefore, the basis of the common shares would be $46,875. And then once we consider that, we just calculated the basis of the preferred, and we calculated the basis of the common. So when we factor in the two, this would equate to the total basis we just allocated between preferred and common shares. This brings us to our next question. And it states, how is the distribution treated for tax purposes? It states, at the start of the current year, Blue Corporation, the calendar year taxpayer, has accumulated E&P of $100,000. I'm going to put some space here. All right. There's accumulated E&P of $100,000. Have too many zeros. All right, of $100,000, and the current E&P is $60,000. All right, and then from there, it lets us know that it distributes $200,000, $100,000 each to its equal shareholders, Pooja and John. All right, so based on this information, we know that the total distribution is $200,000, $100,000 to Pooja, and $100,000 to John. All right. And then it says Pooja's stock basis is 11,000. And John's stock basis is 26,000. All right. So based on this fact pattern, we ultimately need to determine how are these amounts going to be treated. So as we know, to the extent that a distribution is made from the corporate earnings and profits, the shareholder is deemed to receive the dividend. That's either taxed as ordinary income or preferentially taxed dividend income if it is qualified. So we have the fact pattern. Now we need to determine how much is each individual going to recognize as dividend income, capital gain, or stock basis, and how much would the stock basis be worth after the distribution. So in such case, we see that there's accumulated E&P of 100,000 and accumulated E&P of 60,000, but the full amount of distributions cannot be treated as dividends. Why? Because in such case, there's insufficient earnings and profits. We see that in total, the total E&P accumulated is 100,000, current is 60,000. So for a total of 160,000, however, $200,000 worth of distributions were issued. So therefore, we need to figure out how much is going to be treated for each individual. So for both Pooja and John, and let's do it this way. Let's see, total distribution. For both Pooja and John, what we would do, we have the 100,000 plus the 60,000. We add them together. And then in such case, we would divide it by 2. So 160,000 divided by 2. So therefore, Pooja would recognize dividend income of 80,000. And John would also recognize dividend income of $80,000. So the dividend income is going to be subjected to the reduced tax rate on dividends available to all individuals. So here we taken care of the 160,000. We fully used up the accumulated and the current earnings and profits, but we need to realize that there's an extra $40,000 in total, an extra $20,000 for each shareholder. So based on this, we need to determine how much is going to be treated as a return on capital and how much is going to be treated as a capital gain. So we're actually going to look into this. The problem doesn't ask for it, but I want to make sure that you guys see, because with the distributions, again, it is based on a 3-tier, so return of capital. So in this case, for Pooja, his stock basis is 11,000. But again, there's an extra $20,000. 80,000 was treated as dividend income. 100,000 was distributed. So therefore, of the return on capital, 11,000 is treated as return on capital, reducing the basis to 0. And the excess of 9,000 is treated as a capital gain. So for Pooja, dividend income of 80,000. The total distribution was 100,000. So therefore, there was a reduction, a return of capital of 1,000. So the stock basis is now 0. And the excess $9,000 is treated as a capital gain. Now for John, on the other hand, $80,000, which is treated as dividend income. And in such case, the return on capital, we know that $26,000 represents John's stock basis. So the entire $20,000 in excess is going to be treated as a return of capital. There's no capital gain because there was enough stock basis for John to absorb the excess distribution. So therefore, John's stock basis is 26,000 minus the amount of the distribution treated as a return on capital. So John's stock basis after the distribution is $6,000. All right. So just a key thing to keep in mind as we work through these problems, as it relates to the distribution of dividends, it is treated as dividend income to the extent of current and accumulated E&P. From there, it is treated as a return of capital. Then it's treated as a taxable gain if there's any excess. And for any amount that is treated as a return on capital, it has a direct reduction to the stock basis after the distribution. So here we have this problem, and it says complete the following schedule for each case. Assume that the shareholders have a sufficient basis in the stock investment. All distributions are made at year end, December 31st, except for Part E. For Part E, assume that the $130 distribution is made on June 30th. So I have all the information here. We'll look at the Excel. So we know that there are specific rules as it relates. Make this a little bigger. There's some specific rules as it relates to the distribution and how much is treated as dividends, etc. Okay, perfect. We can see everything. Great. So in this case, rather, we're going to have to factor in the current E&P, the accumulated E&P, because again, distinguishing between the two has a great impact on how the amounts are treated for tax purposes. So in this first scenario, we see that we have a deficit in the accumulated E&P, and then we have a positive current E&P. So we look at the fact pattern. If there is a deficit in accumulated E&P and positive current E&P, how is it treated? So in this case, E&P is going to be netted, or E&P is taxed. In such case, based on current and accumulated E&P not being netted, my apologies, the accumulated has a deficit and the current has the positive. So in such case, the current and accumulated E&P is not netted. The distributions are dividends to the extent of the E&P. And if the distribution exceeds E&P, the excess first reduces the stock basis to zero and generates a taxable gain. And based on the fact pattern, it says, assume that the shareholders have sufficient basis in the stock investment. So therefore, based on this fact pattern, $70,000 is going to be treated as dividend income. And the difference between the cash distribution versus how much is being treated as dividend income, the remaining amount is being taxed as a return on capital. So this was the fact pattern for this example. For the second example, maybe I'll put it in colors because that might help us to differentiate between them. So we'll use a light orange. So this situation is based on light orange, deficit and accumulated E&P, and positive current E&P. For the next scenario, we have a positive accumulated E&P, but a deficit in the current E&P. So for this fact pattern, we will use purple. All right, so we're following this set of rules. Current and the accumulated E&P is going to be netted. And in such case, any loss in the current E&P is deemed to have accrued ratably throughout the year unless the corporation can show otherwise. So therefore, if the net amount is positive, the dividend is just to the extent of the balance. And if negative, none of it is treated as. Let's make these blue as well, or purple as well, since this applies, right? So in this case, we net the two. 150,000 versus 120,000. So once we net the two, so the sum of the two, this will give us a positive 30,000. My apologies. Positive $30,000. So therefore, the remaining amount of the cash distribution minus the netted amount of the current E&P deficit and the accumulated E&P of positive of 30,000 leaves us with a return of capital of 180,000. In scenario C, we have a current or accumulated E&P positive balance, and we have a positive current E&P balance. So this is this scenario. We are going to make this green. And it will be treated as follows. Our accumulated E&P is 90,000. Our current E&P is 70,000. That is a total of 160,000. So therefore, we have a sufficient amount of earnings and profits to cover the entire distribution. So therefore, the entire 150,000 is treated as dividend income. There is nothing to be treated as a return on capital. So for scenario D, we have a positive accumulated E&P, but we have a deficit in the current E&P. So this falls in line with our purple fact pattern. So with this fact pattern, if we net the two, the 120,000 and the 60,000, we see that we have a net of $60,000. But one thing we need to keep in mind with fact D is that we determine the net amount. But again, now we need to factor in, and here we see that with this problem, it's saying that all distributions are made at year end December 31st. But then for part E, it's going to say, assume the distribution was made on June 30th. So here we see it was made at the end of the year. So therefore, the cash distribution minus the net amount, which was positive, of 60,000, there we have a return on capital. So we have a similar fact pattern here, but it's a little different. So we're going to bold it. right? Because instead of it being distributed at December 31st, in such case, when the resultant current E&P is a deficit for the year, the deficit is allocated on a pro rata basis to distributions made during the year. So on June 30th, the earnings and profits would be $90,000. You might say, well, what? How do we determine that? So if the current E&P is a deficit of 60,000, then that would mean if it's 60,000 for the entire year, then we would ultimately determine that the sum would be as follows. The 120,000, and then we would factor in 1/2 of the current E&P, because again, the distribution was made on June 30th as opposed to the distribution being made on the last day of the year. So therefore, we need to allocate the deficit on a pro rata basis. So 1/2 of the loss is accounted for, allocated to the first half of the year. Oh, that is way wrong. Let's see, B14. Oh, should it be minus? Should be subtract. Oh, this is negative. All right, so it'll be 90,000. So the reason why I had to subtract it is because when we are dealing with Excel, and even when we're dealing with PEMDAS, just addition in general, a negative plus a negative gives you a positive, positive plus positive. So in such case, because this is a negative, I have to put a plus sign. So this is just going back to basic math. All right, but again, another way we could look at this is 60,000 is the loss, the deficit for the entire year. The distribution was made on the 6th month, 1/2 of the year. So 1/2 of 60,000 is 30,000. So we could do 120,000 minus a negative 30,000, which would give us 90,000. So based on that fact pattern, the total cash distribution was 130,000 minus the dividend income of 90,000. So because the distribution was made on June 30th, 1/2 of the year, the deficit would be allocated for that 1/2 of the year. 90,000 would be treated as dividend income, and 40,000 would be treated as a return on capital. So this brings us to our next problem. And here it asks, is the fair market value of the rights 15% or more of the value of the old stock? Answer the following to determine the tax consequences of this transaction to Lauren. Denham Corporation declares a non-taxable dividend payable in rights to subscribe to common stock. One right and $60 entitle the holder to subscribe to 1 share of stock. One right is issued for every 2 shares of stock owned. At the date of distribution of the rights, the market value of the stock is $110 per share, and the market value of the rights is $55 per right. Lauren owns 300 shares of stock that she purchased 2 years ago for $9,000. Lauren receives 150 rights, of which she exercises 105 to purchase 105 additional shares. She sells the remaining 45 rights for $2,475. So the first part of the question is the fair market value of the rights 15% or more of the fair value of the stock? So the rules for determining the taxability of stock rights, it's identical to those for determining the taxability of stock dividends. In the event that the rights are taxable, the recipient is going to have to report income that's equal to the fair market value of the rights. The fair market value, then it's going to become the shareholder, the distributee's basis in those rights. In the event that the rights are exercised, then the holding period for the new stock, it would begin on the date that the rights, whether they are taxable or non-taxable, Whether or not they're exercised makes no difference. The holding period for the new stock begins on the date that the rights are exercised. And the basis of the new stock, it's the basis of the rights plus any amount of any other consideration given. So when stock rights are not taxable and the value of the right is less than 15% of the value of the old stock, the basis of the right is zero. However, the shareholder may elect to have some of the basis in the formerly held stock allocated to the rights. In this election, it'll be made by attaching a statement to the shareholder's return for the year in which the rights are received. And in the event that the fair market value of the rights is 15% or more of the value of the old stocks, and the rights are either exercised or they're sold, then in such case, the shareholder has to allocate the basis in the formerly held stock. So we're going to look at this information. We'll start off with the fair market value of the stock. How do we determine it? So it says that she owned 300 shares. So there were 300 shares. And it lets us know that the price per share was $110 per share. All right, so that gives us 300 shares times 110. That gives us 33,000. And then the fair market value of the rights are as follows. The number of rights, 150 rights per problem. And it lets us know that the price per right is $50 per share. So 150 rights multiplied by $50 per share. So when we add these two up, we get a total of $41,250. So now from there, we need to determine, okay, well, what is the basis of the stock and what is the basis of the rights? So in order for us to do that, the basis of the stock would be determined as follows. $9,000, which represents the initial basis. And then we divide the fair market value of the stock divided by the total value of the stock in addition to the right. So therefore, the basis of the stock in this case will be 7,200. And next, as it relates to the basis of the rights, it will be the initial cost, the initial basis, which in this case was 9,000, multiplied by the fair market value of the rights divided by the total value of the fair market value of the stock plus the rights. So that lets us know that in such case, the basis of the rights is 1,800 and the basis of the stock is 1,700. And then obviously, if we add the two, that gives us the $9,000. But again, because of the fact pattern, it was allocated. So now based on this information that we were able to determine, now we need to figure out, okay, well, what is the basis per right? So we know the basis of the rights, which is a total of 1,800. And it lets us know that the total rights we received were 150. So therefore, the basis per right is $12 per share. So based on this information, we need to determine what is the calculation of the capital gain. So the sales price of the 45 rights, the problem lets us know, was $2,475. And we know that the price per right or the basis per right is $12. She sells 45 of those shares. So 45 times 12 gives us $540. So therefore, our long-term capital gain is $2,475 minus 540. So therefore, our long-term capital gain is $1,935. All right, and in this case, is the fair market value of the rights 15% or more of the value of the old stock? The answer is yes in this case. All right. And how do we confirm that? We confirm it as follows. 8,250 divided by the fair market value of the shares, it is 25%. So therefore, that is why the answer to that question is yes. So here, just to go over it again, is the fair market value of the rights 15% or more? The answer is yes, because as we calculated, the fair market value of the rights, which we calculated as 150 rights multiplied by $55 per right, which gave us 8,250, divided by the fair market value of the stock, which we determined based on 300 shares that had a market value of $110 per share. So the fair market value of the rights, 8,250 divided by the fair market value of the stock, 33,000, gives us 25%. So therefore, the answer to this is yes. Now we move on to the next part of the question, and it asks us to calculate the basis of the new stock. So we sold 45 shares, and we have the additional 105 shares. So therefore, 105 shares times 12. And then in essence, we also have additional consideration that we need to take in place. So we have 105 additional shares to factor in. Or in this case, let me rephrase it to make sure there's no confusion. We have 150 rights. We exercised 105 to purchase. So this is the 105 multiplied by 12. So the 105 rights multiplied by $12 per right. And then there's additional consideration. We have one right and $60 to entitle the shareholder to one share of stock. So 105 additional shares times $60 per share. So 105 times 60 for a total of 6,300. So our basis in the newly acquired stock is 7,560. And the holding period for the new shares begins on the date of purchase. So again, there's a lot going on in this problem, but again, with the Excel formula, it kind of helps to work through it. The key thing is we start off with the calculation of the basis per rights to determine the basis per right. And from there, we can determine and calculate the capital gain, and we can also calculate the basis on the new stock. Here, this brings us to our next question, and it asks us, how much better off would Kirsten be if she were paid a dividend rather than a salary? How much better off would Egret Corporation be if it paid Kirsten a salary rather than a dividend? Assume Egret Corporation paid Kristen a salary bonus of $35,000 instead of a $30,000 dividend. And D, what should Kirsten do? So there's a lot going on in this problem, but it's similar to the problem that we saw before. So it states, Kristen, the president and sole shareholder of Egret Corporation, has earned a salary bonus of $30,000 for the current year. Because of the lower tax rates on qualifying dividends, Kristen is considering substituting a dividend for the bonus. Assume that the tax rates are 24% for Kirsten and 21% for Egret Corporation. How much better off would Kirsten be if she were paid a dividend rather than a salary? So this is dealing with a closely held corporation, and closely held corporations, as we mentioned previously, they have a considerable discretion regarding their dividend policy. So in such case, in the past, the double tax provided strong motivation to avoid the payment of dividends. Why? The corporation pays taxes on the net income, and then when dividends are distributed to the shareholders, they also have to pay taxes on the dividend. So in such case, the incentive was basically to bail out the corporate profits in a manner that provided benefits to the corporation, because when dividends are paid to shareholders, unfortunately, it is not deductible. So one of the key questions becomes, should the corporation or should the shareholder benefit? So in general, the best strategy, you want to make sure that you consider the tax consequence to both parties. So in this case, in the event that Kirsten receives the $30,000, we want to determine what is her after-tax bonus amount. So the after-tax bonus amount, I think the fact pattern from the previous problem was a bit easier. All right, so I think I'll copy this over. I think this was a bit easier. Yeah, so we'll use this clear content, clear content. All right, and just some information that we're going to need to know. So what is the bonus amount? 30,000. What would the dividend amount be? All right, fairly similar. 30,000. Again, we're trying to determine what would be the best thing to do. So 30,000 would be the dividend amount. What is Kirsten's tax rate? If she took the bonus, it would be 24%. What would Kristen's tax rate if it were a dividend? 15%. And what would Egret's tax rate be? 21%. So if the amount were treated as a dividend, let's make this a little smaller. All right. This bigger. All right, so if the amount were treated as a dividend, 30,000, and then it would be the payment, which is 30,000, multiplied by the tax rate of 50%. So the after-tax amount would be as follows: 30,000 minus the 30,000 times the 15%. The after-tax amount for dividends would be 25,500 versus if it were a bonus. 30,000, the payment amount of 30,000 multiplied by the tax rate of 24%. The after-tax amount would be as follows: 30,000 minus the 30,000 times the 24%. So in such case, if it were a bonus, the after-tax amount would be 22,800 versus if it were a dividend, the after-tax amount would be 25,800. So if Kristen were paid a bonus, she would receive 22,800 after taxes. If Kristen receives a dividend rather than a salary, she would receive 25,500 after taxes. Thus, she would be better off by receiving the dividend, right? She takes home 25,500 versus only taking home 22,800. The dividend would work better in her favor. So for B, it asks, how much better off would Egret Corporation be if it paid Kirsten a salary versus a dividend? So the net after-tax cost of the bonus for Egret Corporation would be as follows. So if Egret Corporation paid the $30,000 bonus, they'll be able to receive a deduction. So in order for us to determine the amount, it'll be 30,000. And then we consider the tax rate. The tax savings would be $6,300. And then we need to figure out, well, what is the net after tax cost? So in order to determine the net after tax cost, it would be calculated as follows. So the payment minus the tax savings equals the net after tax cost. All right. Oops, sorry. Equals net after tax cost. All right. So the payment amount is $30,000. The payment amount is $30,000. The tax savings, as we just pointed out, is the $30,000 multiplied by the tax rate, which is 21%. So the net after tax cost is the $30,000 minus the tax savings. So therefore, the net after tax cost would be $23,700, and the net after tax cost for the dividend. And in such case, there's a contrast because a dividend payment, unfortunately, is not deductible. So therefore, the net after-tax cost for the dividend payment would be $30,000. It is not deductible. So therefore, Egret would be better off. They would save $6,300 if they paid a bonus versus a dividend. But again, we want to make sure that it works for both corporations. So assume Egret Corporation paid Kristen, a salary bonus of $35,000 instead of a $30,000 dividend. So again, similar to the fact pattern for which we calculated up above. So we're going to copy this information. We'll change it. Instead of it being a dividend, it would be a bonus of $35,000. The payment would be $35,000. And the tax rate, her tax rate is 24%. So therefore, the after-tax amount in such case would be $26,600. The $35,000, in consideration of her tax rate, the after-tax amount would be $26,600. And the bonus would cost Egret how much after taxes? So in order to determine, we do the following. Oh, sorry about that. All right, so it'll be as follows. $35,000 payment multiplied by 21%. So therefore, the net after-tax costs for Egret will be $27,650. So based on this information, it appears as though Egret Incorporation would be better off with a $35,000 bonus. All right, so again, there's a lot going on in this problem. But again, one of the key things is making sure when you're dealing with, a situation like this, a closely held corporation, what is going to benefit the corporation the most? And in such case, we see that the bonus, although the dividend benefits the shareholder better, you want to determine what is going to benefit the corporation overall, because again, this is a closely held corporation. So we want to look at it from a holistic perspective. All right, so we move on to our next question. Here it asks, a distribution in excess of EMP is treated as capital gain by shareholders. So this answer is false. Reason being is because distributions in excess of both current and accumulated EMP are first treated as tax-free recovery of capital. So it is a return of capital, which reduces the shareholder basis. So to the extent of the stock basis, any distributions in excess of that basis, that is what triggers a capital gain. Next, we see the terms earning and profits and retained earnings are identical in meaning. So this is also false. So the notion of earnings and profits, again, it's similar to the accounting concept of retained earnings. Both essentially measure a firm's accumulated capital. However, there are some differences in the ways in which the figures are calculated. The computation of retained earnings is based on financial accounting rules, whereas earnings and profits is ultimately dependent on tax laws. Earnings and profits, again, this is a measure of economic income. It determines the corporation's dividend paying capacity. Here it states all cash distributions received from a corporation with a positive balance in accumulated E&P at the beginning of the tax year will be taxed as dividend income. This is also false. Why? If there's a positive balance in accumulated E&P at the beginning of the year, it does not guarantee dividend treatment for distributions. If there's a deficit in current E&P during a year, then a dividend treatment may not result at all. Here it states the tax treatment of corporate distributions at the shareholder level does not depend on blank. So it says the basis of stock in the hands of the shareholder. No, that does have an impact, because in the event that there's not enough earnings and profits to be treated as dividend, then the stock basis has an impact on the amount treated as a return on capital or capital gain. So it can't be A. C, the character of the property being distributed. That seems like a good answer choice, but let's go through all of them. The earnings and profits of a corporation. This definitely has an impact. And again, we need to distinguish between current earnings and profits as well as accumulated earnings and profits. So C is not the answer. D, whether the distributed property is received by an individual or a corporation. That does have an impact. So therefore, B is the correct answer. The property of the character that is being distributed does not have an impact on the tax treatment. So here it asks Rose Corporation's current E&P is. Rose Corporation, a calendar year taxpayer, has taxable income of $300,000, and its financial records reflect the following for the year. Federal income taxes paid of $110,000, net operating loss carry forward deducted currently of $70,000, gain recognized this year on an installment sale from a prior year of $44,000, depreciation deducted on a tax return, ADS, accelerated depreciation would have been $10,000, and interest income on Iowa state bonds. So we will pull out our handy dandy calculator to determine this amount. So in order to determine E&P, we start off with the taxable income of $300,000. The federal income tax is subtracted from taxable income, and the net operating loss carry forward is added. Therefore, the gain recognized currently from the prior year's installment sale is subtracted, and the excess of depreciation deducted on the tax return over ADS and the interest from Iowa state bonds are added. So how do we determine this? We start off federal income taxes paid. This is money that's being paid out, $110,000. The net operating loss, we're going to add that amount back. The gain recognized from the prior year installment sale is going to be subtracted, $44,000. The excess of depreciation deducted on the tax return over the ADS depreciation is added back. So we add back the $30,000. Let's start that over. 300,000 minus 110,000. From there, we subtract the net operating loss. Oh, we add back. I'm getting too much information going on here. We add back the 70,000. We subtract the gain recognized from the prior year installment sale, so the 44,000. From there, the excess depreciation deducted on the tax return over ADS depreciation is added. In addition, we add the interest income on the Iowa state bonds. So our total E&P would be 254,000. So I'm actually going to We're going to annotate. So just so we know, these amounts are subtracted. The federal income tax is paid. The net operating loss is added. The gain recognized currently from the prior year installment sale is subtracted. The interest income on the Iowa state bonds is subtracted. Oh no, added. Let me delete that. All right, this amount is added. And then the same thing for the depreciation deducted. But the key thing is that here we account for the difference. So the 40,000 minus the ADS of 10,000. So therefore the difference of 30,000 represents the amount to be added. All right, so I'm going to run through that again quickly, and then we would be on our last question. So we start off with the taxable income of 300,000. We subtract the 110,000. We add back the 70,000 for the net operating loss. We subtract the gain recognized on the installment sale from a prior year. We add the difference between the excess of depreciation depreciated on a tax return over the ADS depreciation, which was 30,000. And then we add the interest income on Iowa state bonds, which gives us Roses Corporation's current E&P of $254,000. All right, and this brings us to our last question. Here it asks, what is the maximum amount of the distribution that could potentially be treated as a dividend? Robin Corporation, a calendar year taxpayer, has a deficit in a current E&P of $200,000 and a $580,000 positive balance in accumulated E&P. If Robin determines that a $700,000 distribution to its shareholders is appropriate at some point during the year, what is the maximum amount of the distribution that could potentially be treated as a dividend? So whenever there's a deficit in the current E&P and a positive balance exists in accumulated E&P, the two accounts need to be netted. However, if the distribution takes place on the first day of the year, then it's deemed to be paid entirely out of accumulated E&P. So as a result, here we see $580,000 would be treated as a dividend, and this is the maximum distribution that can be treated as a dividend. So in such case, Robin determines that $700,000 distribution to shareholders is appropriate at some point during the year. Again, it ultimately depends on when the distribution is being made. And the maximum amount would be $580,000 if the distribution took place on the first day of the year. If distributions are paid later in the year, it's a ratable share of current E&P. The E&P deficit would be decreased. And in the event that the distribution was made on December 31st, we would net the $580,000 into $200,000, and the maximum dividend would be $380,000. So again, the timing of a dividend payment, or the timing rather of a distribution, also has an impact. So this brings us to the end of several questions for chapter 5, which covers corporations, earnings and profits, dividend distributions.